Run away. Foreign capital is withdrawing from China on a large scale. Recently, foreign fund managers have withdrawn funds from Chinese index stock funds (ETFs) on a large scale. Foreign capital has recently withdrawn funds from China's index stock funds (ETFs) on a large scale, and this has continued for 4 weeks, indicating that the market's confidence in China's economic prospects is significantly declining. According to Bloomberg, the root cause of this wave of divestments can be attributed to 2 points. First, the results of the U.S. presidential election showed that Trump won, which triggered market concerns about additional tariffs on Chinese exports. Second, Beijing's economic stimulus measures have failed to give investors confidence in China's ability to effectively respond to upcoming economic challenges. Last week, China's large-cap ETFs with a scale of 9.5 billion US dollars saw outflows of $315 million US dollars, marking the 4th consecutive week of withdrawals since large-scale capital inflows in early October. During the same period, the MSCI China ETF also experienced an outflow of $280 million US dollars. Roxana Islam, director of industry research at TMX Vetafi, pointed out, Trump has always advocated reducing dependence on China and promoting U.S. manufacturing, which has put China ETFs under great pressure. She further added that with Trump's victory, investors are optimistic about the prospects of the U.S. stock market, and coupled with possible changes in trade policy, many international funds have chosen to withdraw from the Chinese market. In addition, the Trump administration's tax cuts and deregulation policies have also made investors more optimistic about the U.S. market, thus weakening interest in risk assets. Beijing's recently announced stimulus measures also failed to spark market enthusiasm. The plan was mainly aimed at easing the debt burden of local governments, but failed to provide the comprehensive fiscal support expected by the market. Islam believes that investors were expecting Beijing to launch more powerful stimulus measures to deal with China's growing debt problem, but now they are disappointed with the lack of a comprehensive plan and the uncertainty of China's policy after Trump's victory. Trump effect emerges as Chinese and Hong Kong stock markets fall together. Hong Kong stocks fall below 20,000 points. On Tuesday, November 12th, China's A shares and Hong Kong stocks fell collectively, with Hong Kong stocks falling below 20,000 points again. Analysts pointed out that the reason was the market's disappointment with the CCP's economic policies and concerns about Trump's potential return to power. On that day, Hong Kong stocks continued the decline from Monday, closing down 580 points, or 2.84%, at 19,846 points, falling below the 20,000-point mark. Last Friday, the 10 trillion yuan debt reduction measures from the Standing Committee of the National People's Congress disappointed the market. After the market opened on Monday, Hong Kong stocks fell sharply, closing down 1.45% that day. The opening performance on Tuesday was still good, with stocks rising slightly at one point but soon turned around and fell sharply, at one point dropping by more than 600 points. Market analysts believe that the reasons for the recent decline in Hong Kong stocks include the depreciation of the RMB, the market's disappointment with the CCP's so-called rescue policy, and the influence of the Trump effect. On Monday morning, the 3 major A-share indexes also fell sharply but rebounded in the afternoon, closing higher on the same day. However, on Tuesday afternoon, A-shares took a sharp turn downward. As of the close of the day, the Shanghai Composite Index fell 1.39%, the Shenzhen Component Index fell 0.65%, the Beijing Stock Exchange 50 fell 1.98%, the Science and Technology Innovation 50 fell 0.98%, 2.17%, and the Chinext Index fell 0.07%. Mainland financial media reported that the trends of A-shares and Hong Kong stocks reflected the market's disappointment with domestic policies that were not as good as expected, and concerns about Trump's potential return to power. This sentiment was particularly evident among foreign capital. Trump launched the U.S.-China trade war during his previous term, which severely damaged the Chinese economy. During his presidential campaign, Trump repeatedly stated that he would impose a 60% tariff on Chinese goods. It is generally believed that Trump will take a tougher economic policy toward the CCP after he takes office as president next January. Many foreign investors are stepping up their withdrawal from China to avoid tariff risks. Chinese people are fleeing mainland China, sending $250 billion abroad in 4 quarters. Due to increasing concerns about the current situation, Chinese people are transferring funds abroad through various channels. Analysts believe that this is the inevitable result of the CCP's ideological governance. Although the CCP implements foreign exchange controls and the annual purchase and settlement quota for each person is $50,000, more and more Chinese are transferring large amounts of funds abroad through cryptocurrencies and by setting up shell companies. The Wall Street Journal recently reported that, according to statistics, in the 4 quarters ending in June, assets that evaded CCP supervision and moved overseas amounted to $254 billion, which is more than the funds that fled China in the past decade. Between 2015 and 2016, there was a wave of capital outflows caused by the decline in real estate. The actual amount is said to be even more. Epoch Times columnist Wang He said, "This incident only shows that China's current economic situation is very bad. People from all walks of life who have a little money are thinking about transferring funds out to preserve value and hedge risks. Not only that, since the outbreak of the epidemic, because the CCP has implemented a closed policy and continued to suppress private enterprises, foreign capital has also fled China." According to data released by the State Administration of Foreign Exchange of the Communist Party of China, foreign direct investment in China's international balance of payments decreased by US $14.8 billion from April to June this year, setting a record high. Wang He said, "At present, whether it is the elite class or the general public in China, the Communist Party of China has to cut their flesh to replenish the economy. But this has formed a vicious circle. Everyone is more urgently and unscrupulously transferring funds out, which has accelerated the decline of the entire Chinese economy." Faced with the sluggish economic situation, the Communist Party of China has recently launched a series of so-called economic stimulus policies. Analysts believe that due to the Communist Party's economic model dominated by a planned economy, these policies will be difficult to boost the economy. Li Hengqing, an economist at the Washington Information and Strategic Institute, said, "Even if some monetary policy adjustments are made now, it is only to stabilize the economy and consolidate the regime, and then some tricks are released. That is not real. What is the core purpose of the trick? To cheat money, to deceive you into investing, and wait for it to recover and deal with you anyway. And those ordinary people who have no ability or channels to transfer assets can only leave it to fate." Wang He said, "So in the current situation, people are eager for change, and the whole society is in a state of chaos and confusion." International fast fashion brand Oysho closes online and offline stores in China. Recently, Oysho, a subsidiary of the world-renowned fast fashion giant Inditex Group, announced that it will stop operating its Tmall official flagship store, the only online channel in China. The other 3 brands under the group had previously closed their online sales channels. In just 9 months this year, the number of Oysho stores in the mainland market decreased by 21, with an average of 2 stores closing each month. Daily Economic News reported on October 22 that Oysho Tmall's online customer service staff said, "Due to the company's business adjustments, we will stop the operation of Oysho Tmall's official flagship store from November 17th. It is reported that Tmall is the only online channel officially operated by Oysho, with 3.77 million fans. Founded in 2001, Oysho was originally positioned as an underwear brand, but later gradually added sports and leisure categories, expanding its product line to include big sports styles, and even introducing shoes, bags, rackets, trekking poles, etc. Product prices start from a few dozen yuan, and the most expensive can reach thousands of yuan. Oysho and another fashion brand, Zara, belong to the Inditex Group. After 3 years of the epidemic in China, Oysho's stores in Suzhou, Shenzhen, Chengdu, Xi'an, and other places have been closing since the end of 2023. In March this year, the Inditex Group released its 2023 fiscal year annual report, showing that, as of January 31, 2024, Oysho had 25 physical stores in the mainland market. According to the Inditex Group, Oysho currently operates a total of 4 stores in the mainland China market. According to a comparison of financial reports, in just 9 months this year, the number of Oysho stores in the mainland market has decreased by 21, with an average of 2 stores closing each month. However, in terms of performance, Oysho is still growing in the global market. According to the Inditex Group's 2023 fiscal year annual report, Oysho's sales increased by 10% to €744 million, accounting for about 2% of the group's overall sales. In addition to Zara and Oysho closing their mainland stores on a large scale, in 2022, when the epidemic in China was at its peak, 3 brands under the Inditex Group, Bershka, Pull&Bear, and Stradivarius, issued store closure notices in their respective e-commerce flagship stores, announcing that from July 31, 2022, the 3 brands' Tmall official flagship stores would stop selling the brand's product lines, and the brand's online customer service and brand customer service hotlines would be extended to August 31st. In fact, not only are many brands under the Inditex Group closing stores, but fast fashion giants such as H&M and Uniqlo have slowed down their development in the Chinese market and have closed stores one after another. In addition, fast fashion brands such as Superdry, Old Navy, and C&A have successively withdrawn from the Chinese market. Xi'an Taxation Bureau office building collapses. On-site video goes viral. On the evening of October 23rd, a netizen posted a video claiming that a taxation bureau office building in Jilin City, Jilin Province, had collapsed, and many police cars had arrived at the scene, with the road being closed. The building collapsed, and the police cars are here. A witness filmed a video at the scene of the building and said, "The video shows that under the cover of night, a building had severely collapsed and turned into a pile of rubble. Many people were watching at the scene, and the police were blocking the road." The video poster wrote, "At about 8 o'clock in the evening on the 23rd, a taxation bureau office building on Guanghua Road in Jilin City collapsed. Baidu Map shows that the Guanghua Road office area of the State Administration of Taxation's Jilin City Chuanying District Taxation Bureau is located on Guanghua Road in Jilin City." A citizen driving past the scene filmed a video saying, "No one is allowed through. The road has been closed, all blocked, and you can't get through." The video shows many police cars parked at the scene of the building collapse. A merchant on Guanghua Road confirmed to Jimu News that a tax bureau building opposite his shop had indeed collapsed. Another nearby resident said that he heard a boom and thought that some structure had collapsed. Later, he heard police cars and ambulances rushing to the scene, and when he went out, he saw that the tax building had collapsed. The resident said that the building used to be the tax bureau's office hall. It had recently been under renovation, and the people inside had moved to other locations to work. The police station in the area where the tax building is located responded that the building was under renovation before it collapsed and that there were no casualties. However, the police's response raised doubts from netizens. They said there should be no one after work hours, but is there really no one on duty at night? Why call an ambulance if there are no casualties? Some netizens also said that many old buildings in Jilin are at risk of collapse. They are too old. The old buildings in Jilin City should have been demolished long ago. They are older than me.